Hi, my name's Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And before we jump into today's Q&A episode, I just wanted to give you a bit of a heads up because, we expect some significant changes to taxation that will be announced on the 12th of May in the federal budget. So that's next week, of course. I just wanted to reassure you, I'll keep you updated on these sorts of things, whatever sort of arises out of the budget. Of course, it's all speculation at this stage. But what I plan to do is I will record an episode. So the episode on Wednesday, the 13th of May, which is really obviously the day after the budget, will be all about the budget. So I'll give you a summary of the budget through that episode. On the 14th, Thursday the 14th at lunchtime, Mina Abraham, who is my co-host of the Holistic Accountant podcast, and I will do a live Q&A on YouTube. So that's at lunchtime. We'll be sending out an email in regards to that. We would have sent it on Monday, in fact, and I'll include a link in the show notes. So we're going to do the podcast, we're going to do a Q&A, and then beyond that, we'll just see what happens. Of course, we don't really know the extent of the changes and then how we might navigate those changes or help investors navigate those changes. So we've got to see the detail to work out what else do we do beyond that, if anything. But just rest assured that, if you're a listener of this podcast, a part of this community, we'll keep you posted and we'll certainly help you through it. And I think the most important thing or message to say is we can't jump at shadows either. So what is proposed on budget night most likely will have to be legislated. So until we see the law, until the law is actually approved, until it actually becomes law, my general advice to people is just don't do anything yet. We have to see the law. We've got to wait for it to become law before we react. So no overreaction is required. I suspect, I don't know, but I suspect it'll move things at the margins. It won't, make investing in property, for example, no longer attractive or anything like that. And there's always ways to sort of navigate these things or minimize the impact of some of these changes. So I'm sure there'll be solutions out there. No need to worry. And I just wanted to reassure you that, we'll be on top of it. Okay, so let's get into the first question today. First question is from Stefan. Stefan writes that I'm hoping to lean on the experience of Stuart Weems or Campbell Wallace for some balanced feedback. Long-time admirer of the podcast, listened to every episode since day one and have gotten many family and friends hooked. So thank you so much for your support, Stefan. I'm glad you've been a long-time listener and hopefully I can help. So Stefan writes that they've been doing all the hard work, especially through their 20s and early 30s, to get themselves in a really good financial position. And they're going to start a family, as in have kids soon, and they would like to, have a more comfortable, balanced lifestyle that allows them to do a bit of traveling, spend more time with family, those sorts of things. And really the question comes down to, do they retain their investment property and high leverage, or do they sell the investment property, have lower leverage and, potentially a more comfortable standard of living, if you like? So a bit of a rundown. Stefan's 36, his wife's 34. He earns 150, she earns 90. Super 330 plus 120, both with ART, Australian Retirement Trust, 30% in Aussie, 70% in international. All growth. Good on you, Stefan. I think that's a good idea. The home's worth $2 million with about $600 of debt. The investment property's worth $650 with $236,000 of debt. Some ETFs. So in the wife's name, 95,000 with 68,000 of debt. Husband's name is 122 with 105 of debt. Cars worth about 200,000, owned outright. So total assets about 3.5. Total debt about 1. It's about 2.5 mil of net assets. So option one is sell the investment property, which obviously not only reduces the debt associated with the investment property, which is only, when I say only, 263. I mean, it's relatively low for investment debt, but also there's quite a bit of equity in that asset, 400 pre-tax. So let's say just roughly 300 post-tax. So they could halve their home loan. So it could have a pretty significant impact on their debt profile. Or alternatively, do they keep the investment property? I should have mentioned their goal is to have enough wealth outside of super at age 55 to, work as much as they want. So it's not just about super. We want to have access to early retirement. Okay, so there's a few considerations here. The first thing I would think about is how much CGT do I have to pay? And I'm actually loath to mention that as the first point because I think most investors are over focused on taxation consequences, which is tomorrow's podcast topic, actually. So it's kind of a good sort of segue, if you like. So I don't think we should be too overly focused, but, delaying paying capital gains tax isn't a bad idea. Delaying paying any tax isn't a bad idea just because of the time value of money. So would I prefer to pay $200,000 of tax in 20 years' time as opposed to $100,000 today? That's probably a silly example because the difference is going to be much larger than that, most likely. But yes, of course, I would like to delay it. So that's the first thing I would think about is, how much CGT am I going to pay? The next one would be how effective is this investment and arguably how effective is this investment within my portfolio? And with a property investment, it's going to come down to really two things: future expected capital growth of the asset, the amount of leverage I've got against this asset. So the amount of leverage Stefan's got against the asset is pretty low. It's leveraged about 40%, so 40% of the asset value, which is not ideal. In his situation, you probably want 100% leverage against the investment in return for having less non-tax deductible debt. Now, in Stefan's situation, it's really important. Leverage is a really important factor because he's 36, wants to have flexibility at 55. So we've got a 20-year time horizon, which is perfect for leverage, perfect for an investment property that provides a lot of compounding capital growth. So he's got $650,000 exposure, investment exposure to the market. That is ideal. What's not ideal is the amount of leverage against that asset, and that's actually going to make it less effective. I think it's really important too because, yes, he can incrementally invest in ETFs, but one of the advantages that property has over shares is that people tend to invest more sooner with property. I mean, they have to, right? You can't go and buy 5% of a property each year. If you're going to invest in property, you're really contemplating a sizable one-off investment. Now, that's a negative in terms of it's inflexible and it's a large commitment in one foul swoop, but it's positive from a mathematical perspective because it forces you to invest more sooner. So if I'm advising Stefan, I think that's a really important strategic point in the overall strategy, that an incremental debt recycling strategy, so pay down the home loan, borrow against the equity in the property and keep building out those ETF portfolios, that is a good strategy, but it's incremental and it's not going to be mathematically as effective as having a $650,000 or more exposure to the market, to a market, a growth market, for instance. So what are some alternatives? Well, Stefan could sell the investment property and use $300,000 of net proceeds to pay down his home loan, so have a lower non-tax deductible debt, and then go and replace the investment property with a 100% geared investment property. So that might even include selling for $650 and then going and buying for $650. It's not ideal because you think about the transactional costs, the selling costs, the CGT, and then paying stamp duty to go back into the market. I imagine if you did the numbers in terms of future numbers, it would be probably worthwhile. My gut feeling, you could mathematically justify doing it, but it's not ideal. And also, I think if I'm going to get back into the market, I probably want to have a budget higher than $650 just so I make fewer compromises in the quality of the asset. Stefan could sell and gear into shares, but gear into shares more aggressively. That's certainly an opportunity. So, for instance, we've got $600,000 home loan plus $260,000 investment loan. So total debt of $860 against property, and then we've got some other debt against the shares and so forth. So what he could do is if he paid the home loan down to $800, he could go and borrow $500,000 and put that into the share market. And don't forget, I did a podcast of that recently, episode 403, which is about lump sum share investing, and then episode 405, which is about how to construct an ETF portfolio. So we could use the information I provided in those episodes to construct something that sounds risky, right, to a lot of people in their mind. Borrowing $500,000 and putting all in the market, in the share market, in a very short space of time sounds risky, but there's ways that you can manage the risk associated with that. I think what I'm leaning to is that we want to retain the gearing, that I think an inferior strategy in Stefan's situation is sell the investment property, pay down the home loan, and then incrementally gear into ETF portfolio. That could work. Like, that could still work in terms of helping him achieve his goals, but it's an inferior position to what he's currently got. And yes, there are, there's always a cost to everything, right? It's true, financially, but in many things in life, there are always compromises to make. And so one of the compromises he's contemplating at the moment is higher level of debt, higher stress, those sorts of things. The advice that I would give people in that situation, not be blind to these things. I mean, they're important considerations. And so I've heard Stefan's feedback, so I want to acknowledge that. But also, part of it is time and part of it is mindset. So the mindset part is, becoming comfortable with the debt position. Sometimes stress or anxiety around these sorts of things can be more of a mindset thing than a practical thing. Because, there's some people out there that if they had $100,000 of debt, they'd be uncomfortable with, and other people be comfortable having $3 million of debt, right? So it's just about the story they tell themselves about money, their experiences, maybe some of their history, these sorts of things. So I think the best way that I've been able to deal with this personally is by making short-term commitments. So in Stefan's situation, he might say, look, I'm not going to change anything now. I acknowledge it's a little bit more stressful. It would be great if I could pay down the home loan to sell the investment property, pay down the home loan to 300. That would make me feel really comfortable. But for now, I'm not going to do that. I'm going to commit the next 2 years to maintaining my status quo. And then in 2 years' time, if I'm still really uncomfortable with it, I'll revisit the situation. I've taken that approach many times through my life. And the reality is, in 2 years' time, I've been a lot more comfortable than what I was 2 years prior, because selling is a very long-term decision. You want to think about, in 20 years' time, we'll look back and say, thank God I sold that investment property. Probability is, and certainly over my 25 years worth of experience, probability is no. Probably is you'll regret selling. So kick the can down the road a little bit is sort of way of dealing with that. And then also, and related to that, is that what seems like a lot of money today won't seem like a lot of money in 5 years' time, or at least will seem like less money in 5 years' time. Just the nature of inflation, it's very slow. It's a slow burn. But, if I think about 20 years ago, what a really large home loan looked like, anything north of $1 million was ridiculous, was uncommon. Today, it's very common, for instance. So it will get easier. It will get better. Things will generally improve. I'm not saying be blind to it and don't worry about it, but they will improve. So just be cautious when you go through stages of life. You want to really focus on that 10, 20-year time horizon. Ask yourself questions around that. And then ask yourself, how can I make it more comfortable for myself? So can you improve the property's cash flow? Can you just sort of make friends with holding the status quo for a while and becoming comfortable over time? So what would I do in Stefan's situation? I think my answer is don't change the debt levels. I think my answer is that holding this level of exposure to a growth asset, you've got $650,000 of exposure through the investment property to a growth asset class, I should say. I think it's important to hold that. So I wouldn't change. But what you might do is you could change it to shares rather than property. So you could sell the investment property and, as I said, go and borrow $500,000 and put it into the market. Would you be comfortable doing that? Do you have the skills to put a portfolio together that helps you mitigate risk as much as possible? I don't know. That's something you're going to need to think about. But if you're not going to do that, then I think I would say to you, why don't you just make the commitment for the next 1 or 2 years to hold the status quo, and why don't you review it after that? Why don't you review the assets performance as well? Because if the property isn't generating good returns, then that it does make a case for potentially divesting it. That would be my advice. And hopefully, Stefan, I know it's a very long-winded explanation, but hopefully it helps you and similar people in your situation. Okay, next question is from Max. Max is 45 years old. He's a real estate agent in Melbourne. Home is worth $1 million with about 325,000 debt against it. 230 in super, 65,000 in cash in the offset account, 15,000 in crypto, and a little bit of ETFs. Also has an unused $150,000 investment loan against the home as well. So money's in the offset, hasn't used that. And income ranges from 80 to 130,000. Wife is 34, just going to have their first child. She's going to take 12 months maternity leave and go back to work. She normally earns about $80,000, has about 80 grand in super, and still has a help debt. They expect to work into their 60s and perhaps beyond. So kind of got one sort of eye on building out their career and income and one eye on sort of investing. Haven't really been that focused on investing until now, but they feel like they need to do something. And they want to eventually in 5-10 years upgrade their home to a property in Elwood, probably costing about $2 million in today's market. So sort of double the value of the home, if you like. A couple of options that Max has suggested: do nothing, just put all the money in offset, repay debt. Option 2 is use the $150,000 loan to invest in ETFs. And number 3 is use a $150,000 loan as a deposit for an investment property. I should mention that Max's risk tolerance is stated to be moderate to low. However, I'm willing to introduce some high risk options as part of my portfolio. Look, I think with risk profile, I think we're all the same, right? We're happy to make investments, but we don't want to lose capital. And if we can make 7 to 10% compounding per annum, that's going to be enough. Asset base is going to double every 10 years. Investment asset is going to double every 10 years. That's probably enough to make things work. So I think most people I'll like to take the lowest risk possible to earn 7 to 10% per annum, which is very much what I talk about in the podcast. Very much the approach that I talk about in the podcast. So what would I do if I was in Max's situation? And it might sort of surprise you, but I would focus on income. I would focus on building out your career. That's where I'd be putting almost all of my energy. I don't think, going out using the 150,000 going buying an investment property. Max has said, look, that's probably going to get us a 1 to 2 bedroom apartment in Elwood. And I've heard you talking about the flat market in Melbourne, and he's sort of saying, well, I've looked at the figures and I can see that in the data. And I've also mentioned before, around investment grade apartments, the underperformance in Melbourne has been terrible. It's been terrible for about 13 to 14 years. And I reckon the epicenter typically of that underperformance is investment grade apartments in Armadale and investment grade apartments in Elwood in Melbourne. So for those listeners that know Melbourne well, you'll know those suburbs. For some reason, all markets perform terribly in Melbourne, but those ones are certainly probably done a little worse than the rest. Now, you can form a view, and I've shared this view many times, that when a market is flat for a long period of time, the resurgence when it does kick off is going to be very strong. I think that's true. These apartments now, the land value is worth more than the actual apartment. So you're getting the building for free. That doesn't make a lot of sense. To rebuild these buildings would cost a lot more than, what their market value is. That doesn't make a lot of sense. So it will kick off soon. But the thing I think, and Max has said, look, there's a bit of upside in earning capacity in their careers. The thing is that if you make a long-term plan, you make a long-term decision, such as buying an investment property today, and your financial position changes substantially, say over the next 3 to 4 years, then that original decision might not be appropriate. So if I say, okay, well, let's make a decision that is appropriate for your circumstances today, we might, and if it was to include going and buying investment property, I'm not suggesting it is, then we're going to set the budget quite low because your capacity is relatively low, and we're going to make some compromises. But instead, what I could do is say, let's not do anything material now. Why don't you go away and spend the next 1 to 3 years really honing your craft, investing in yourself, building out your skill, really going hell for leather to try and increase your income. And then if you come back to me in 3 years' time and your income now is $300,000 a year, that opens up more opportunities. And I'd make a different decision, arguably a better quality decision. So you could certainly use some gearing. That's $150,000 loan that's unused. You certainly could use some of that and put it into the share market and, use some of the more recent episodes that I made reference to at the beginning of today's podcast to help you, select some really good ETFs to do that. I'm not against that. So I don't think doing nothing necessarily is the right answer. But if I was in your situation, I'd be focusing on income. Now, you might think, and the reason I would say put all my energy towards that is that I think focus is a really undervalued skill and an undervalued benefit that is underutilized by many human beings. I talk about it to my team at Pro Solution about, working on one or maybe two projects at once, but not more, and putting all your energy and momentum behind those projects rather than trying to optimize, 40 things all at once. So for Max's situation, I would say, look, you might just do some stuff, with the ETFs, on the margin, but I would be putting all my focus and energy on building out my career because I think that's your biggest leverage point. And that's what's really going to be necessary. You're going to need more income to be able to make that transition from a $1 million home today to a $2 million home in 5 to 10 years. So not traditional investment advice there, Max, but thanks for writing in and thanks for listening. I hope that's been helpful. Okay, next question is from a listener that wants to remain anonymous. Provides me great feedback about the podcast. Particularly, I did an episode on tax reform, expected tax reform, or suggested tax reform, I should say, not expected. That was published in December 23. I don't have a episode number, but it was published on the 6th of December 2023, for anyone that's interested in going back. And the listener writes, I hope someone in the right department was listening. I don't think it matters even if they were. I really just not optimistic about good quality tax reform in Australia. Question is a two-part question. What do I think about net wealth and similar sort of products like that? And then when does it make sense to use those sorts of platforms? So for those who've been following the media, there was a business called First Guardian. They invested, as I understand it, they did a lot of cold calling saying you should move your super to us. These are the returns we're going to get you. People moved their super across. The investments blew up, really poorly managed, and they lost money. And they used Macquarie and NetWealth as platforms to make those sorts of investments. I mean, there's a couple of red flags here that I think probably I would like to think anyone that's a regular listener of this podcast wouldn't fall foul of because they've educated themselves. But, if someone just calls you up out of the blue and says, move your super, that's got to be a red flag to begin with. If someone's promising, unusually high returns, that's got to be another red flag. In fact, if any advisor talks about returns, I think it tends to be a red flag. I know that sounds really stupid, right? Because that's one of the things you hope to achieve is better returns by getting professional advice. But the thing is, most people know, I mean, over the long run, returns are relatively predictable, over the next 20 years or something like that, it can be predictable. But, what happens over the next 1 or 2 years, no one really knows. I can't control markets or returns. What I can control is how and where we invest. And I can take an evidence-based approach with that. I can say, if we had have done that over the last 20 years, here's what the outcomes would have been. But at the end of the day, I can't control markets. And that's an important point to make, I think. So when advisors start talking about returns, I think that starts to really, what you're getting advice on is how and where to invest, not really how to achieve a 10% return. So they're the red flags. Look, I think platforms like Macquarie and NetWealth and Hub24, they're probably, there's a few of these sorts of platforms out there. It's a bit of a challenge. What they're trying to do, they're just a platform, right? So they're not giving you advice. They're not saying these investments are the best investments. Okay, yes, they're the trustee of a super fund. So they've got to make some checks and balances, have some checks and balances. But ultimately, those platforms exist to give you, the person, full transparency over your investments and full control over your investments. Now, NetWealth has admitted to ASIC that it didn't do what it should have done. It's paid $100 million. I can't remember how much. Macquarie paid a lot more than that. I think it might have been $500 million or something like that. So there's some fault here. But I think most of the criticism should rest with First Guardian themselves, the directors, the management, anyone that worked in that business, anyone that employs high pressure sales tactics, anyone that's selling a product that is fundamentally flawed. There's always going to be people like that in every industry. You can't reduce that to nil. but they're the ones that deserve 95% of the blame, not really Net Wealth themselves. We deal with Net Wealth, we deal with Macquarie, we've dealt with Macquarie for more than 20 years. We've only been dealing with Net Wealth for 3 or 4 years. I don't have any concerns. I think for the best part, they're doing their best with these sorts of things around compliance. At the end of the day, I think the buck stops with the advisor rather than the portal or the platform that the advisor was utilizing to deliver their advice. But there's no doubt that regulation is insufficient. I'm happy to go on record to say that I think, as a general comment, has done a terrible job at regulating the financial advice industry. They've been late to the party in almost every sort of collapse or businesses that have done the wrong thing. So they haven't really protected or saved Australians, and I think they could be doing a much better job. It's probably not entirely ASIC's fault. The law needs to be rewritten. So the financial services law was written in the late 90s. The market has changed so much since then. The financial advice market and industry, almost everything has changed since then. So the legislation is no longer appropriate. It's no longer fit for purpose. They need to rewrite the legislation. That will make sure that ASIC can focus on the things that matter, not the things that don't. At the moment, they're really focusing on the things that don't matter, spending all their time doing that. Meanwhile, you've got people like First Guardian doing the wrong thing. That should have been stamped out. I mean, there should be red flags that if, one super fund is attracting hundreds of millions of dollars in a short space of time, ASIC should be knocking on the door, not with the view to saying we believe something's wrong here, but you're seeing a lot of growth. Let's look a little bit deeper. I don't think it would be that difficult to pick up. Similarly, if a financial advisor has gone from 2 advisors to 40 advisors in a very short space of time, ASIC should be, going and visiting their office, interviewing the directors of that business, understanding how they're controlling that growth. Again, it's not difficult. They've got all the data. So I think there's been a lot of things wrong here, but I don't blame the platforms. And look, I'm completely independent, by the way. If I thought the platforms did a bad job, we would sack Net Wealth and go somewhere else for our clients. And I would not hesitate to say so. But I think that they've been dragged into this, and sure, they've probably contributed, or they probably could have done something to help. But ASIC and First Guardian, I think, are at the top of that list rather than the platforms. Now, the second part of the question is, would I use these platforms? Well, we use these platforms for most of our clients. There's some advantages, significant advantages. Firstly, costs. So when you look at industry funds tend to charge high percentage-based fees. Most of the percentage-based fee relates to the management of the investments, and that percentage-based fee could be anywhere from 0.5% to 1%, typically somewhere in the mid-range of that, 0.6, 0.7. Whereas if with platforms, the administrative fees are lower. They're still percentage-based, but they cap out. So they have a cap on the fee, which allows superannuation investors to get some scale. And then the weighted average cost of our index portfolios using the evidence-based, rules-based approach that I talk about are around about 0.3%. So they're about half the percentage-based cost than what industry funds are. So there's a strong cost element. Then you've got full control and transparency. So you don't, your super fund isn't being used to, pay for training for unions or sponsorship or TV ads or any of this sort of stuff. And when you look at percentage-based fees in the industry fund sector, they've been rising rather than reducing, even though they've got tremendous scale. So you've got full control and transparency. And the last thing is the tax drag. So if you're on a platform until you go into retirement, you get to avoid paying capital gains tax on your super. Now, to what extent that adds value, how much can you quantify that? That's difficult to quantify, but they're probably the 3 attractions. The listener asked, would I ever diversify? Yes, I would. And sometimes we do. So sometimes we will have, for many different reasons, we might have, a client might be at UniSuper, for example, and their spouse might be on Net Wealth as a platform. Quite often we would have both spouses on a platform, just really depends, but it is certainly one way that you can diversify manager risk. So if you've got a financial advisor managing a portfolio and then you've got UniSuper managing a portfolio, you do diversify your manager risk. But I think it just depends on, circumstances, how much you believe in the approach, and fees. I mean, fees, I don't want to overemphasize fees, but fees are guaranteed. They're certain. Returns are difficult. Returns are uncertain. Taxation outcomes, they're uncertain. Rules and laws can change. I might rebalance or do something, so these things are uncertain. But what is certain is fees. And fees, we can all become quite used to fees in environments where we've had double-digit returns, like the last few years. Paying 0.5%, not that big a deal. But in lower return periods, people start to focus more on fees. And I think I don't want to be overemphasized because it's fees, it's returns net of fees that are really ultimately going to drive outcomes. But I think there is often a compelling basis for using a platform when you add the fees involved. So thank you for your question. I think it's a good one. It was a great excuse for me to talk about First Guardian and all the problems there. And let's hope, that the regulatory environment improves over the coming years to minimize the chances of these things happening, because, they just really shouldn't be allowed to happen. It should be easy for ASIC and the regulators, and potentially even the platforms providers can play a role in it, to avoid situations like that happening. Okay, so as I said, tomorrow I'm going to talk about the issue of investors over obsessing about taxation, and that taxation drag on investments can be material, but there's a lot of other things that we want to be optimizing. And I wanted to talk about this leading into the budget next week, because I think it would really sort of set the scene to say, okay, yes, tax is important, but it's only one of many considerations. And quite often there's other factors that play a bigger role in us achieving our desired returns. Okay, so until tomorrow, bye for now. And before you go, if you enjoyed this episode, please share it with someone that you think will get value from it. And if you have a moment, leave a rating or review on Apple Podcasts or Spotify, as it really helps more people find the show. If you have a question you'd like me to answer in the next Q&A episode, email it to questions@investopoly.com.au. And if you'd like to learn about my new book, Wealth by Design, which is out in a few months' time, head over to investopoly.com.au/book. The link is also in the show notes. And you can also register for the pre-order offer, which is an AI tool that you can use to get more personalized value out of this podcast. Thanks for listening.